Hello and welcome to the webinar on Demystifying the Portable Retirement Gratuity Fund, organized jointly by Andersen Mauritius Chambers. I am Zainab Isun, Senior Tax Manager at Andersen Mauritius, and I'll be the moderator. I have the pleasure to welcome three distinguished guests with me today. We have Mr. Mamadou Ouzia. Welcome, Mr. Ouzia.
Thank you, and good morning to everybody.
Good morning. Mr. Ouzia is the Director of the Operational Services Department at the Mauritius Revenue Authority with an extensive 40 years of experience in tax administration. I also welcome Mr. Bernard Yen. Welcome, Mr. Bernard. Mr. Bernard is an actuary and is the Managing Director of Aon Solutions Limited. Mr. Bernard has more than 35 years of experience in advising on pension funds and provident funds. We also have with us Mrs. Zuleka Abasakour. Welcome, Zuleka. Zuleka is barrister at law at Prism Chambers, and she advises a wide spectrum of clients on corporate and tax law matters. Zuleka currently sits in Turkey, the reason why she joined us by Zoom today. Welcome to all of you. PRGF has indeed been making the buzz on the island since the start of the year. And the theme for today's webinar is demystifying the gray areas of PRGF and addressing the impact of PRGF on employers and on the recovery of the Mauritian economy following the COVID-19 pandemic. We hope that the webinar will answer the questions that many of you may have, particularly on the employer choice between a private pension scheme and contributing into the PRGF. We'll be having a Q&A session at the end of the webinar, so feel free to post your questions at the bottom of your screen, and we'll take them at the end. Let me start the discussion. So the Portable Retirement Gratuity Fund has been introduced under the Workers' Rights Act, and it is effective since 1st of January 2020. It is a fund established for the purpose of providing for the payment of a gratuity on the retirement or death of a worker. Since its introduction, 2-year suspension period was provided, and unfortunately this came to an end, such that as from January 2022, monthly contributions are required, and that to the rate of 4.5%. On the other hand, to the relief of certain categories of SMEs, there are lower contributory rates for a period of 3 years, with the difference being financed by government from a seed capital. One of the positive aspects of PRGF is that when we talk about gratuity, it recognizes the entire length of service of the worker, irrespective of the number of employers served during his career. Definitely, as a new piece of legislation, PRGF has come with its ambiguities, and I'll start with Mr. Ouzia. Can you provide us with more insights about PRGF, in particular how the fund in itself is structured?
So, in fact, employers will have started contributing to the PRGF since January 2020. Then, as you said, we had the suspension period, but those who have already contributed had the choice to continue to contribute, or also they had the choice to stop contributing and to start again in January 2020. So how the fund is structured, it's managed in a way, if we can say, by the PRGF Advisory Committee, which consists of a chairperson. Then there is a representative of the Ministry of Finance and a representative of the Ministry of Social Security. And we have 3 representatives of the workers and 3 representatives of employers. So they are required to define the policy with respect to PRGF and advise the minister on any changes that need to be approved. Regarding the fund itself, it is established, as you said, under the Workers' Rights Act, and there is the Investment Committee, which has the responsibility to determine the level of liquidity that needs to be kept, as well as the investment that needs to be made. The investment committee for the PRGF is the same investment committee that is applicable for the National Pension Fund. Under Section 38 of the National Pensions Act, there is the investment committee. So the same investment committee will decide on investment. And what are the elements that will go in that fund? Of course, there will be the contributions paid by all employers. There will also be, when I say contributions, including all surcharges and penalties, there will also be the seed capital, the contribution of government with respect to the subsidy for the first 3 years for SMEs. There will also be, of course, the return on investment, because these funds will be invested and will generate revenue, and the revenue net of investment expenditure will be credited to the fund. And out of the fund, there will be the payment of gratuity to employees on retirement. If death occurs before retirement, there will be this outgoing, and there will be also, of course, expenditure in relation to the administration of the fund. So this is, if we can say, a summary of how the fund will be administered.
Thank you, Mr. Uzia. This is a very good summary. There were definitely several consultations before the introduction of PRGF. Beno, do you mind sharing your experience about those consultations? In particular, how has the rate of 4.5% arrived at?
Yeah, thank you. Going back to 2019, when the Workers' Rights Act was being drafted, I had an opportunity to comment on the bill at the time, and also help Business Mauritius in discussions with government and the unions about the framework and how it should be set up, etc. I remember in particular the discussion about the contribution rate, because if you remember correctly, 2019, the first rate that was proposed was 4.8%. The 4.8% was a straight calculation of the gratuity that is supposed to be paid, which is 15 days per year of service. Okay, 15 days of remuneration per year of service, 15 divided by 26, and if you do the maths, you will see that it's actually 4.8. And I remember that commenting then at the time that the rate was theoretically probably too high, that rate, because usually when you set up a fund and you invest the money, you should be able to contribute at a lower rate than what you expect to pay at the end. So I remember doing some calculations. I can't remember exactly the rates that I came up with. They came to probably something like 3.5%. And of course, the rate in theory depends also on how quickly people's salaries or remuneration grows over the 30, 40 years, that usually the period that would be taken into account. So I did suggest that the rate could start at a lower level, especially at that time, if you remember, we're still a bit concerned about economy and how much burden that would place on enterprises. But unfortunately, we did not, well, in the end, the rate was settled at 4.5%. I think one of the concessions, put it this way, one of the agreements at that time was that it would not be paid on the 13th month. Now, I'm not sure whether that's still applicable. I think I would need clarification on that. But if you don't pay on the 13th month, then in theory, the rate of 4.5 on 12 months was closer to what I was proposing the rate should be. I also remember many discussions about the nature of the payment, to what extent the benchmarking, which I'm sure we'll be coming on to that later, should be applied or not. So there were discussions on that. There also circumstances in which it should be paid. And one thing that I'm glad was done, at some point it was not clear, is that on resignation, the full period of service is not taken into account. This is an important fact, because it does make it more sustainable. You know, when you set up a new fund and you want to recognize 20, 30 years of service, who is going to pay for it? So there was a concession at that time that for resignation, only the period of service from 1st of January 2020 would count.
Yeah, that's correct. And I think that's the main nuance between a termination retirement versus a resignation, which we'll definitely cover in detail later in the webinar. Now, we spoke about the object of PRGF is to provide for gratuity, but gratuity in itself was already part of the existing legislation. If I may invite Zuleika to comment on the nuances in terms of gratuity between the previous Employment Rights Act and the current Workers' Rights Act.
Thank you, Zainab, for the question and for giving me the opportunity to participate on this webinar. So, yes, as you mentioned, under the Employment Rights Act, there was already, an obligation on the employer to pay a gratuity upon retirement or death of the employee. So this gratuity did not reflect the entire length of service of the employee, because if the employee was changing employers throughout his career, then only the last employer who was witnessing the retirement or the death of the employee would have to actually pay this gratuity. So the Workers' Rights Act actually tried to remedy this loophole by introducing the PRGF. And now all the employers have to pay into the PRGF on a monthly basis. And the gratuity that is paid to the employee at the end of his career, so when he retires or when he dies, the gratuity that will be paid will reflect his entire length of service if he has changed employers. So I think that's the main loophole that the PRGF is trying to remedy. And I think it's important also to note that the lump sum gratuity is calculated based on a formula, which is 15 days remuneration for every period of 12 months, and it's the same formula that is being used today. So this has not changed. I think one important aspect that I would also want to highlight is that many employers think that the PRGF is actually a tax. It is not a tax. It's the PRGF is an investment fund. It's an investment that is being made by the employer for the gratuity that will be paid to the employee at the end of his career. So it should not be confused with a tax. So I think these are the main points that I wanted to make about this.
Okay, thanks, Zuleika. That's very clear. Moving to the practical and reporting aspects of PRGF, the law does provide, so firstly, the law provides for some exclusions to PRGF. For example, if an employer is contributing into a private pension scheme, or for a worker drawing a monthly salary above 200,000 rupees, for job contractors, migrants, non-citizen, and so on. And we saw that the PRGF guide was released by the MOA last week on Friday. And based on this, we saw that there are some additional exclusions added. For example, for a worker who has not attained 16 years old, or someone who is working under a contract of apprenticeship or under a training scheme. And this is fair enough, and it does make sense. Thank you, Mr. Ozier, for that. Now, for employers to which the PRGF is applicable, our understanding is that in addition to the monthly and annual PRGF returns, we also have the exit statement and the past services return. Mr. Ozier, can you elaborate on those additional reporting requirements, and also what happens in the event of a retirement or death? We can probably project Mr. Ozier's slides.
Okay, so the PRGF starts by putting in place a system where employers are required to contribute every month. So every employer will start by contributing every month, but of course, as you said, there will be those exclusions, like those whose employers are contributing to a pension fund and where provision is being already made for the payment of the gratuity. There will be those in the civil service. There will be the employees who are contributing to the statutory body's pension fund and so on. So there are a number of exclusions. Otherwise, every employer will be required to pay 4.5% of the remuneration of the employee into the fund. Now, what happens is that for SMEs, as you said, there will be a reduced rate, and all those payments will continue until the employee exits his employment. So when we say exit, there are 4 possibilities of exit. How an employee stops being employed by his employer. Firstly, there is his resignation. He decides to stop being employed by this employer. He chooses to go to another employer. He chooses to perform another activity and he stops his employment. Secondly, it may be that the employer terminates the employment of the employee. And then we have got, of course, the employee reaches the retirement age and decides to retire, or maybe the last one, the employee dies before date of retirement. So these are the circumstances that we would qualify, we would describe as exit. So each time there is an exit, the employer is required to submit what we call an exit statement. Why there is this requirement to submit the exit statement? Because when an employee is exiting his employment, there is the obligation to carry out what we would call a benchmarking exercise. What is the benchmarking exercise? The employer has been contributing 4.5%, and this is like an estimate of what would be required for the employer to be able to comply with his obligation when the employee would retire. That is, let's put it in simple terms, 15 days salary for every completed year of service. So on exit, the employer will have to submit the exit statement, and the administrator, which is the Ministry of Social Security, is required to carry out a benchmarking exercise. So what is this benchmarking exercise? It is the comparison between the lump sum payable, which is, let's say, 15 days salary for every completed year of service with that employer, compared to the amount that the employer has been contributing. So let's say an employee who starts employment, let's say in January 2022, so it works perfectly, which means that during the whole of his career, he has been with one employer. So this will be the perfect situation. But even though, because the gratuity is calculated on the closing salary, there may be some shortfall when we calculate 15 days salary for every completed year of service compared to the amount contributed plus the return on investment. There may be a shortfall or a surplus. So this shortfall or surplus will have to be made good by the employer. And in case of retirement or in case of death, the employer will settle that shortfall directly with the employee, or in case of death, with the heirs of the employee, right? Yes. But in case of termination of employment, or in case of the employee himself voluntarily leaving his employment, this shortfall will have to be paid to the MRA, and following a claim that will be issued by the administrator, that is the Ministry of Social Security, following the benchmarking exercise. So this is the importance of the exit statement to do the benchmarking.
Okay, thanks, Mr. Uzier. Zuleika, if I may ask you, so Mr. Uzier mentioned 4 types of exit. It's very clear in terms of termination, retirement, or death, but then in case of resignation, what does the law provide in terms of reporting obligations?
Yeah, so as mentioned by Mr. Uzier, there are reporting obligations to be made when the employee is exiting. And there is also a difference in terms of, first of all, I would like to talk about a bit about past services. So there is an obligation for an employer to actually make contribution for POS services in addition to the current PRGF contributions that the employer is making. So, but when he needs to make that contribution for POS services is an option that is being given to the employer. So he can make it to the MRA right now, or he can make it when one of those exit options are happening. So basically, if the employment is terminated, or the employee retires, he dies, or he resigns. So there is a difference, as we mentioned before, between the POS services that needs to be paid for an employee who, there is a difference in terms of the contribution for an employee who resigns and an employee whose employment is terminated, or he retires, or he passes away. So the difference is that for an employee who resigns, the PRGF contribution will cover the period between the 1st of January 2020 until when the employee resigns. So it will be a shorter, the length of service will be shorter for him. Whereas for an employee whose employment is terminated, or where he retires, or where he dies, then the employer will have to file an exit statement again. And the POS services contribution for this employee will be longer because it will cover the start date of employment until when these events occur. So it's going to be a longer length of service for these employees. So as Mr. Uzier mentioned, each time the employee is exiting through, whether it's a resignation, whether his employment is being terminated, whether he's retiring, or whether he dies, an exit statement needs to be filed by the employer with the MRA. And that's when, the employer will be required to either pay POS contribution if he has not paid, or if he is already paid, then any surplus or shortfall will actually be notified by the MRA to the employer. So I hope I answered your question.
Yes, thank you, Zuleika. Mr. Uzier also mentioned about the specific formula that the administrator at the level of the Ministry of Social Security would use based on the 15 days salary, and also made reference to a benchmarking. But then in calculating the net gratuity, I guess the contributions that have been made under the PRGF or under a private pension scheme, it will then be deducted from that total gratuity. What are your views on that, Zuleika?
Well, in terms of a private pension scheme, I think we will come to that a bit later with Bernard, but in terms of a private pension scheme, the employer does not really have an obligation under the PRGF. So what happens is that the gratuity that needs to be paid by the employer under the Workers' Rights Act when he's contributing to a private pension scheme, because there is a confusion in the mind of many employers. They think that when they're contributing to a private pension scheme, they don't have a liability to pay the gratuity. It is not the case. They still have a liability if the employee is retiring, or is dying, has died. Sorry, and the gratuity that is paid by the employer in this case is between the employer and the employee. So the MRA will not interfere in that. So the deductions that will be made by the employer in terms of the contributions that he has made to the private pension scheme will be deducted by the employer himself from the liability that he has, and the MRA will not obviously interfere in that under obviously the correction of Mr. Uzier here. But as far as the law is concerned, the employer who contributes to a private pension scheme does not have any PRGF obligation, other than the fact that he has to mention in the first return that he's going to file with the MRA that he is contributing to a private pension scheme, which is approved by the FSC. So yeah.
Okay, thank you, Zuleika. Bernard, would you like to share your views on the way that gratuity is calculated?
Yeah. So as Zuleika mentioned earlier, the calculation of the gratuity in case of retirement or death was already there under the Employment Rights Act, and before then even the Labour Act. What is changing, we covered that already on resignation. There is a new benefit which is provided under PRGF. Under private pension scheme, the benefit on resignation is determined by the rules of the pension scheme. Okay, so typically, a pension scheme on resignation would provide to the person who is resigning a value based on the contributions of the employee, if any, or the employer. And so that was already what we call the portability legislation that has been applying in Mauritius since 1999-2000. So that's already well covered. But I'd like to come back to the deduction from gratuity in case of retirement or death, which there was a slide just now that was shown. Maybe we can show that again on the deductions. This is an extract from the Workers' Rights Act, but it's similar. It was the same. It was very similar in the Employment Rights Act and even the Labor Act before then. What you see there is that if an employer is contributing to a private pension scheme for his employees, he's allowed to take advantage of the first two bullet points that are on that slide. If, for example, the pension scheme provides, typically pension scheme will provide a pension, and at the option of the member, up to a quarter can be taken in lump sum form or gratuity form. So the first two bullet points apply to the lump sum that a person receives from a private pension scheme. And the second bullet point is about the pension, that the residual pension or the reduced pension, we call it, that the person will receive from the private pension scheme. And you see here that the employer can deduct half of the amount of the lump sum that is provided from the pension scheme only in respect of the employer's share of contributions. So for example, if the lump sum is 300,000 in total, but the employer has only contributed 2/3, say the employer was contributing 10% and the employee 5%, has only contributed 2/3, under a bit like under the National Pension Fund, by the way, then only 200,000 can be taken into account. First of all, that's the employer share. Then you can only take half that amount, which is 100,000. So you can deduct, the employer has contributed 200,000, the employee has contributed 100,000. We exclude the employee, that's fair enough, that's his contribution. The 200,000, you take half of that and you deduct it from the calculation of the gratuity, which may be, let's say, it's 500,000. The second point is on the, so the person is receiving 300,000 lump sum and maybe, let's say, pension of, I'm getting my proportions wrong probably, 1.9, suppose a pension of 9,000 rupees, okay? 9,000 rupees, you can see that it takes 5 times the amount of any annual pension. So 9 times 12 is 108, times 5 is about 540,000. However, again, you take the employer share, 540,000, the employer has only contributed 2/3. You take 2/3 of 540, that's, what do you mean? I'm getting lost, 360,000, okay? So, and then you take 360,000 off that. However, what you can see here, and if you look the third and fourth bullet point, you can see a glaring anomaly. If the employer did not contribute to the private pension scheme, he can actually deduct the whole gratuity that he grants to the person at retirement, a bit like under PRGF. PRGF as well, the employer has contributed, let's say, 200,000 in the same example. The calculation is that, let's say the gratuity has to be 400,000, the employer can take, has already contributed 200,000, so he can deduct 200,000 from that. Similarly, the last bullet point, this is a rare event, but it does happen in Mauritius. At retirement, the employer decides that, you know, you've been a good employee, I want to pay you a pension of 10,000 rupees for the rest of your life. They can do that. When they do that, they can deduct 10 times the annual amount. So 10,000 times 1,220 times 10, 1.2 million they can deduct. So what I'm saying here, I'm sorry to take your time on that, but it is an important point which still needs to be addressed, in my view, policy-wise, which we had a chance to comment on it in 2019 when the Workers' Rights Act was being drafted. It was not taken into account. Today, 2 years later, 3 years later nearly, we still have that anomaly. What this is saying is employers who contribute to a private pension scheme cannot deduct the full amount they contribute, whereas if they contribute to the PRGF, they can deduct the full amount. And I think this is a little bit unfair, and it's something which needs to be corrected. I hope it will be corrected in one day in my lifetime before I retire.
Thank you. Thank you. We really hope so for you too. Mr. Uzia earlier mentioned that there will be a technical committee setting up to look after that whole investment behind the PRGF. Zuleika, do you think there will be transparency around the investment being made by the state with regards to PRGF?
Well, the law ensures a degree of transparency. So as Mr. Uzia has already pointed out, the PRGF committee will consist of representatives of the workers' organization and also representatives of the employers' organization. And this committee is required under the law. And this committee is required to publish in the Government Gazette the audited financial accounts of the PRGF, which must indicate all the payments made into the PRGF and out of the PRGF, as well as all the assets and liabilities of the PRGF, and you know, all the investments that are held by the PRGF. So, and also another point is that the Ministry of Social Security is also required to lay a copy of these audited financial accounts in the National Assembly. So yes, there is a degree of transparency that is provided under the law.
Okay, thanks, Zuleika. Now, in the event of a retirement, so definitely the administrator at the Ministry of Social Security will communicate any gratuity that is left to be paid by the employer to that employee. And there might be shortfalls or surpluses. Let's say we have a situation of a shortfall. Can the employer, and in case the employer does not agree with that amount, is there a dispute resolution that may be followed?
Well, the law does not provide any mechanism for employers to dispute this shortfall. In fact, I would say that it's quite hard for employers to actually determine whether there's been a mistake in the benchmarking exercise. This is because we have to remember when an exit statement is being made by the employer, the ministry will carry out a benchmarking exercise. And what is the benchmarking exercise? It will basically involve comparing the gratuity that needs to be paid to the employee and the accumulated fund that is standing in the individual PRGF account of that employee. The accumulated fund actually consists of the PRGF contributions that have been made by the employer, and also all the return on investment, any surcharge, and all of these other components that the employer may not be aware of. So it will be quite difficult for the employer to understand whether there's, you know, been a mistake in terms of the bank benchmarking exercise. And so basically there is this point. So there's no direct mechanism that is provided in the law. But one thing that I want to, you know, point out is that, as Mr. Uzia already mentioned before, in the case an employee whose employment is terminated, the employer is required to pay that shortfall directly to the MRA. And if the employer does not pay that shortfall to the MRA, then the MRA can use its powers under the MRA Act to actually recover that shortfall. But if the employee retires or he dies, then the employer has to pay the shortfall to the employee directly. And in case the employee does not receive that shortfall from the employer, then the employee will have to make a complaint to the supervising officer of the ministry. The ministry will take a look at the complaint, will inquire, and also will send a notice to the employer for the employer to pay that shortfall. So under the law, the employer is entitled to actually dispute that notice that is, you know, being sent to by the ministry. He can dispute that in court. But as I said, and the court has the right to affirm or to revoke this notice. But as I said, it's going to be very difficult for the employer to prove his case, because it is quite difficult for him to determine whether there's been a mistake in the benchmarking exercise, because he won't really be able to understand whether there's been the other components of the accumulated fund that is standing in the individual account of the of the employee. So there is no direct mechanism, but even if there is an indirect mechanism for retirement and death of an employee, it is not really going to work in practice.
Okay, thanks, Zuleika. And if I may ask you, Mr. Uzier, what happens in case there's a surplus?
Yeah, in case there's a surplus, we need to understand that this contribution that is made by the employer, it is in fact a contribution by the employer that is going to be used to pay the gratuity when the time comes, either to pay the gratuity or to credit the gratuity to the account of the employee. So as we said, there may be shortfalls, there may also be surplus. That surplus, if any, is a surplus payment by the employer. So this will be kept on the account of the employer and will be used at a later stage to fund any shortfall that may arise. Because in the computation for an employer who has got many employees, there will be shortfalls, surpluses, etc. Probably, I understand that there will be more shortfalls than surplus. Surplus will be more like an exception, but in case there is surplus, this surplus will be kept on the account of the employer and will be used to set off against any future shortfalls.
Okay, thank you. Moving to the next part of our webinar, which is the employer choice between a private pension scheme and a PRGF. Bernard, can you help us understand the interrelation between these two?
Sure. Okay, yeah, thanks. As you know, as has already been mentioned, typically an employee will be covered either by the PRGF or a private pension scheme. Okay, there are some exceptions as well, but in general, informal employment, if the employer is not contributing to a private pension scheme approved by the FSC, they will have to contribute to PRGF. So there are interesting question which has come up since 2019 from many employers, many of my clients, has been, PRGF is coming, what do you think of it? And in general, I would say it's a good thing. I think it's historical, it's making good history in my view. There are some things which don't make good history, but PRGF is here to stay, and we will see the full benefit of it in 40 years' time. You know, Mr. Uzier just mentioned, in the early years, there will be more shortfalls and surpluses for the simple reason that the shortfall will arise because of past services. So that's why. But fast forward in 40 years' time, when people resign, all their service will be since 2020 and not just half their service, for example, now. So I'm looking forward, well, I won't be here, but we'll see the full benefit of PRGF, and I hope it doesn't, you know, somebody cut it short at that time, you know, and thinks of something better. But it's there to stay. So typically I would answer my clients that PRGF is a good thing. It's giving you a mechanism for funding what you already have on your balance sheet, because as I was saying, the retirement and death provisions are still the same, and employers were already making provisions based on accounting standards. They had to for these payments eventually. So if you think that these provisions will now gradually come down as employers put their money in the PRGF, that will be good for the balance sheet of the employers, good for the security of the employees. The money will be there, safely invested, etc. So that's a good thing. Now, when an employer tells me, but I don't know whether PRGF is going to be well invested, I understand their concerns about that. So they say, well, I want to invest in a private pension scheme. You know, this we know, we were thinking about it already before PRGF came about. What do you think? And I have to tell them, I have to draw their attention to this slide that was just discussed, the deductions, to tell them that unfortunately, if cost is your concern, it's going to cost you twice as much if you want to contribute to a pension scheme compared to PRGF. because to get the same effect, because you are deducting only half under the private pension scheme, it means you have to contribute not 4.5% of remuneration, but maybe 9%. A bit less. As I was saying, the theoretical rate for me may be less than 4.5, and so you could contribute 6% maybe and get the same effect. So unfortunately, many employers get discouraged after that. But I try to get them to listen to me a bit further, because it's not just about cost. I am a traditionalist. You said I've worked in pensions for more than 35 years. In my view, the best retirement benefit is a pension, is an income for life, guaranteed for life. As long as you live, you need money. So the best thing is to get a guaranteed income, be it 10,000 rupees, be it 15,000 rupees, but at least you know every month you're going to get that to live on. Whereas PRGF will give you a lump sum. It may give you a very big lump sum, 1 million at your retirement, and then you won't know what to do with it. Well, a lot of people will tell me they know what they can do with 1 million in the pocket. But I've seen too many pensioners, especially widows, who look for where they put the fixed deposit when it's renewing, and interest rates are coming down. How can they live on the interest of that lump sum? So that's why, in my view, it's unfortunate. Private pension schemes, if I talk to, and some employers have done it, to their credit, in spite of the cost barrier, they have gone for private pension schemes. There was even the FSC complaining that too many applications for new private pension schemes were coming in at the end of 2019 and even at the end of 2021. Human nature is like that. You know, at the last minute, we decide, okay, no, we need to move, and they make application for a new private pension scheme before the end of the year. Sometimes even now, some are still doing it. And I think it's good, because to me, the private pension scheme, which is aimed at giving at least 75% of the investment back in terms of pension, not lump sum, is good for me, in my view, for most employees. Yeah.
And Mr. Uziel, what are your views on that?
I think I would concur with Bernard, because you see, in reality, a lump sum is less interesting than a pension, because a pension, you will get it so long as you live. But what is the need of a pensioner, somebody who has already pensioned off? What is the need? A lot of money in his bank account, or a regular inflow of income? So I would concur with Bernard. But on the other side, the strategy of government, we can say, is a bit like different, in the sense that we'll come back to the debate about CSG and the increased pension, because what government is saying is that under the Employment Rights Act, there was already the obligation for the employers to pay a lump sum on retirement. But this was not working well, because in most cases, the employees were getting their gratuity with respect to their last employment only. This is what the PRGF has attempted to correct, so that the employee, when he retires at the age of 65 or whatever, he gets a lump sum that is calculated on the basis of his full length of service. This is the objective of PRGF. Now, we need to understand that, coupled with that, there is also the old age pension, and there is also the increased pension, which is coming and is linked with the CSG. So this is another debate. But just keeping in mind that objective of PRGF is to correct the shortcomings that we had under the Employment Rights Act.
Okay, thanks Bernard. Thanks, Mr. Uziel, for that. Mr. Bernard mentioned earlier that since 2019 and also in 2020, we are seeing more private pension fund schemes being setting up. And when we look at the Workers' Rights Act, there's no minimum rate that is prescribed in the legislation. And definitely, to make it an attractive product, some schemes may be proposing rates lower than 4.5%, but definitely this will have to go through FSC approval. Zuleika, how do you see the FSC reacting to this?
Yeah, as you said, Zainab, there is no prescribed rate in the law. So in theory, a private pension scheme can offer a lower contribution rate. But as far as I know, the FSC in practice is not approving such schemes. And also, I would like to point out, just like Bernard already mentioned before, it does not mean that when an employer is contributing to a private pension scheme, he is absolved of his liability to actually pay the gratuity in case the employee retires or he dies. So he still has to pay that gratuity that is provided under the Workers' Rights Act. It is only that he can make deductions from that liability. But as Bernard already said, it is not a full deduction, and sometimes it might even cost him more. So even though he is contributing, to a private pension scheme with a lower contribution rate, this will only this will not, change the fact that he still has to pay that gratuity at the end of the employee's career. And I mean, as I said, under the Employment Rights Act, even under the Employment Rights Act, it was the case. An employer could not assume that the employee would not spend his entire career with him. So he had to make the financial provision for it. So in the same way, an employer who's contributing to a private pension scheme will have to make that financial provision in case the employee retires or he passes away. So yeah, that's the answer.
Yeah, thanks, Zuleika. I'll now jump. So I concur with you what you said. And if I wear my accountant's hat, from a purely accounting perspective, definitely businesses and employers will have to make provisions for gratuity payment or in case the employee retire. And definitely they might be impacted by IAS 19, which talks about employee benefits. And PRGF being a post-employment employee benefit, normally there are two categories of plans which IAS 19 provide. We've got the defined contribution plan and we have the defined benefit plan. And looking at PRGF, although there's a fixed monthly contribution, ultimately when the employee would retire, there would be an actuarial assessment that would be made, and there might be investment risk or even returns. And any shortfall or any risk will have to be borne by the employer. So in my view, the PRGF would be impacted under the defined benefit plan under IAS 19. Bernard, do you share my views?
Yes, I do, yeah. In fact, what's interesting is that to the employee, the PRGF is a defined contribution scheme. If you think about the employee who changes jobs and then, each time he leaves, he exits, he resigns and moves to another employer, there's a benchmarking exercise, so something is topped up maybe. And then once that is made, his benefit when he retires will depend on purely on the performance of that fund, those funds invested. So in that way, it's a defined contribution scheme for the employee. But for the employer, it's a defined benefit scheme as long as the person is working for him. Let me put it another way. Yeah, so you're contributing to PRGF, you have 100 employees. While you're contributing to them, you're contributing for 4.5% of remuneration, but this is not the true cost. We know that the true cost will only be determined when the person exits and whether there's a shortfall or a surplus. So in fact, for the employer, it's a defined benefit scheme. So that's why he will have to account for it as a defined benefit scheme. Yeah. As long as the person is with him. When the person exits and goes to another employer, there's a final calculation, final benchmarking, there's a top up, whatever. And then that amount of money that is in the account of the employee remains invested, whether it's well invested or not so well invested, will affect the retirement benefit of the employee at the end. Yeah.
Thanks, Bernard, for that clarification. Now, if we reflect on the employment landscape for the past few years, there has been quite a significant amount of changes. There's the CSG, which is now called the social contribution, which replaced the NPF. Solidarity levy now being administered under PAYE, and now PRGF has kicked in. And The COVID-19 pandemic has not made the life of businesses any easy. There are rising costs, rising unemployment, and the perception of many employers is that PRGF is an additional cost on them. But as we discussed earlier, this is not 100% accurate, because at the end of the day, they had to make provision to pay for the retirement of that employee. Beno, if we assume that PRGF is actually a good investment, in what way can it represent an additional cost to employers?
It will be, in fact, mainly in terms of cash. Let me put it this way. At the moment, employers may have, let's say, 5 million, 10 million, whatever provision they have in their balance sheet, which in fact is supported on their balance sheet by investments that they have. For example, land and buildings. A company will remain solvent as long as its assets exceed its liabilities. So it may have a building and land which is worth 50 million, and it holds 10 million in terms of liability for these. It's still bearable, and it has only maybe 5 million in cash at the bank. Okay, what will happen gradually? There will be a shift of that 10 million provision in the balance sheet into 10 million in investments in PRGF. So what this means is that probably the employer, if they don't want to sell, they will be able to raise, in fact, they will be able to raise more debt elsewhere, because that 10 million is out of the balance sheet, they've paid for it. So what it means is that, in fact, employers generally will have to put more cash regularly, find the cash to put in PRGF, which is a good discipline. But at the same time, it may hurt in terms of employers who previously could rely on that cash to invest and, grow their business. So if, in a way, very, very sort of briefly, good enterprises who make good use of cash will be hurt. Bad enterprises who don't, who have cash sitting and don't know what to do with it or invest it poorly, may be better off putting it in PRGF. So I think it's a bit extreme, but most enterprises are somewhere in between. But many employers tell me, I'd rather put, and it's the same discussion I have with employers with private pension schemes, where they would like to put less money in the pension scheme and keep the money to invest, because they have overdraft, they have loans. They'd rather, cash is king in many ways. So they'd rather use the cash to invest and grow their business rather than put it in a way, in a passive way, investment in private pension scheme or even PRGF. But it's not about, for me, it's not about making best use of it. I think the money in the private pension scheme or PRGF gives better security to the employees, because at the end of the day, if the employer takes the money and invests it and then winds up and they have no money to pay them, that's worse. So I think it's good discipline to put money away, even though cash-wise, of course, many enterprises will find that they have to put back some projects in some investment projects, or they have to raise more loans, to support their cash payments. Yeah.
Thanks, Beno. And what I'm seeing in practice is for employers having the perception that PRGF is actually an additional cost for them, is that they are trying to look for alternatives. And one of the alternatives that we might see is altering the remuneration package of employees, such that they shift from the mass of the remuneration from a basic salary to allowances on which PRGF doesn't apply. Zuleika, does the law provide for any anti-avoidance provision to address such kind of situations?
Well, the anti-avoidance provisions are actually found in the Income Tax Act, but they are not applicable to the PRGF. However, there's something that employers need to keep in mind, is that if they are planning to restructure a remuneration package, it will also affect the contribution sociale généralisée, what we call now the social contribution. And under the Social Contribution Act, the MRA has the ability to actually enforce anti-avoidance provision. And in that case, the MRA is entitled to, adjust the remuneration to ensure that the employer is actually contributing the right CSG amount. But obviously, this is going to have an indirect effect on the PRGF, because the remuneration, the basic salary of the employee will actually increase, and therefore the contribution of PRGF will increase as well. So directly, there is no such, as I said before, PRGF is not a tax, so the MRA cannot really enforce anti-avoidance provision towards the PRGF, but in respect of CSG, it can, and therefore this is going to have an indirect effect, yes.
Thanks, Zuleika. Now, moving to one last question from me. How do you see the longer term impact of PRGF on the Mauritian economy? Bernard.
Yeah, I'm afraid I'm not very good at macroeconomics. There are many people more qualified than me. But I can imagine that, as I was saying, maybe taking a little enterprise and have 5-10 million on the balance sheet, eventually that is sitting in cash. I think this is good generally for the economy, because it's a form of saving. It's a form of compulsory saving on the enterprises, because instead of keeping a balance sheet provision on the balance sheet, putting the cash to be invested. I think it can also, in fact, address one of the concerns I had with CSG and the stopping of contributions into NPF, because if you think about it, NPF is going to go slowly like that. PRGF is going to go up, maybe quicker, I don't know. In a way, it may address some of the concerns that I had, that once NPF doesn't receive new contributions for investment, they will have to sell their assets. So at one point, I imagine there will be a lot of discussions between PRGF and NPF. NPF has a building to sell, and maybe PRGF has money to spend, to invest, and they will buy. I don't know. So these are things we can expect, I think, to happen. So generally speaking, as I say, I'm not a macroeconomist, but I think generally investment savings are good for the economy. So in that way, there will be more investment in PRGF. PRGF, I don't know how big it will be. It could surpass the NPF, in my view, in time. Maybe Mr. Uzier can tell us how much has been collected for the first month.
No, I don't have the figures now. But you see, in fact, we have been collecting since January 2020. But then with the suspension of the PRGF, everything slowed down. It's only now that start picking up again. But I mean, the effects on the economy, I would rather say that I see it more like positive, in the sense that employers will now be more secure, more safe with respect to the burden of paying gratuity to the employees, because this is a burden that will be of them, because it has already been paid. Hopefully the surplus, the shortfall won't be that much, unless there has been a huge increase in salaries during the end of the career of a person. Otherwise, I think it's a good thing. Second thing that I would say, that Bernard said, yes, I mean, it's good that we have got the same investment committee for PRGF and NPF. Yes, of course, the assets of NPF will go down, but then will probably be replaced by the assets of PRGF. In fact, their objective is the same. Mm-hmm. So we can say it's not a bad thing. And the beauty of I mean, we all agree, I think, about the introduction of PRGF is giving the employees correcting the shortcomings that we had under the Employment Rights Act is, I think, a good thing. A good thing in the sense that employees they were entitled to the gratuity for the whole period of the career, but then it doesn't work properly, because either they get it at the time the employers terminate the employment, so many times during their career, or they don't get it at all. But now it's sure they will get it on retirement, which is not a bad thing.
Yeah. And Zuleika, any concluding remarks from you on that?
Well, as Mr. Uzier and Bernard said, I think in overall it's I think a good initiative, because it's correcting that loophole. But obviously I think it is important to make employers understand their obligations, so that they're not confused, and and also make them understand the value behind it. So I think overall, I think it's a good initiative, but obviously we need a lot of education, I think, around the PRGF. Yes.
Yeah. Thanks, Zuleika. We'll now move to the Q&A session of the webinar. So the first question is, let's say there's a company merger. I think the question is for you, Mr. Uzier. 2 company mergers, and there's a surviving company. And the employees of the surviving company shifts to the company that will remain. What will be the PRGF impact? Will there be a need to file the exit statement?
Now, there is in the Employment Rights Act a section that talks about merger, takeover, or transfer of employees. Whenever an employee there is a merger or a transfer, and the employee and the employer agrees to continue the employment as a continuation of their employment, and on terms which is not less favorable than the previous employment, it is deemed to be a continuous employment. Okay. Right? So there is no exit statement to be submitted, of course, if the employee accepts this offer. But if the employee doesn't accept the offer, because even if it is not less favorable, the employee may decide not to accept the offer. In that case, there is termination of employment. And if there is termination of employment, there is exit statement that need to be submitted. Then I think under the relevant provisions of the Employment of the Workers' Rights Act, the employee would not be able to claim unjustified termination. Yeah. Then there is the third situation where the terms of employment being offered to the employee is less favorable, right? If the terms of employment is less favorable, then the employee is entitled not to accept the employment, and the termination is the employee have the choice to consider the termination as unjustified. So these are the different options that the employee have.
Yeah, thanks for that. The next question again for you, Mr. Uzier. I think you're on the hot seat now. Let's say we have an employee who reached 60 years old already, and the employer already paid a lump sum gratuity to that employee, but then the employee decides to continue to work again until 65 years old. What is the impact?
In fact, this situation, I think, is already covered in the legislation again, in the Workers' Rights Act, where the employee at the age of 60, an employee has got the choice to retire, right? But if the employee decides not to retire, but to continue his employment with their employer, there is no exit statement to be submitted. It's only that the employee continues his employment, but then the employee and the employer can agree on the payment of a lump sum at the age of 60, which the employer will deduct when he will compute the lump sum that would be paid when the employee would retire, either at the age of 65 or even after. So when the employee would retire, then the calculation of the gratuity will be made, and the amount that has already been paid by the employer to the employee at the age of 60 would be deducted therefrom and adjusted in a way. Yeah. Okay. So there is a specific provision for that.
Okay. Okay. The next question is for Zuleika. The PRGF is calculated at 4.5% on the monthly remuneration. One question is, what is monthly remuneration?
Well, yeah, this is a good question that is being asked by many people, and I think it's good to clarify it. And I think that the guideline which has been issued by the MRA also clarifies this. So the monthly remuneration means the basic wage that is being paid to the worker, and any productivity bonus, including commission, attendance bonus, payment for extra work performed. It does not include other types of allowances. So basically allowances which are related to productivity, but not other types of allowances such as traveling allowance or phone allowance or these kind of, even end of year bonus. So yeah, that's what the remuneration package consists of. And that's what is going to be, that's the 4.5% will be made on this remuneration to the PRGF.
And when you look at the law, for calculation of gratuity, the law refers to final remuneration. Is there a nuance between final remuneration and monthly remuneration?
Yes, the final remuneration will be the remuneration that is drawn by the employer at the end of his employment. So the last, remuneration that he gets. So whatever, increase that he got until he has left his employment, that's what the calculation needs to be based upon. Whereas monthly remuneration is going to be whatever the employee is getting right now, presently. So whatever his remuneration consists of right now, yeah.
Okay, and this might also include, let's say, for a salesperson, commission, for example, it will be included in there.
Yes, if it's related to the productivity, it will be included in there, yeah.
Okay, thanks, Zuleika. The next question, again for Mr. Uzier. Let's say we have an employee who has been drawing a monthly salary of less than 200,000 monthly, and the employer has been contributing into PRGF, but then as time passes, his salary has exceeded the 200,000 threshold. What happens? Should the employer file an exit statement? Will pause services come into play? What happens?
Yeah, I think in that case, when we talk about 200,000 rupees, it is 200,000 rupees basic salary. So it is expected that it's not going to go down. Once it reaches the 200,000 rupees, it won't go down. Then the employer will stop contributing and will have to submit an exit statement because at that point in time, we'll need to carry out a benchmarking exercise so that the benchmarking is carried out and any shortfall is paid to the MRA, because the employee will continue with the same employer, but with a higher salary, and the employer will stop contributing. Then when the employee will retire, then the employer will have to deal with the employee just like an employer who contributes to a pension fund. So it will be a private thing between the employer and the employee, and any dispute at that moment will have to be settled by the dispute resolution mechanism in place under the Workers' Rights Act. That is, they have to address the issue with the Ministry of Labour. But hopefully there won't be this type of dispute. Then for the employee to get, let's say the employee now reaches retirement, he will have just to apply for the payment of the accumulated fund with the return on investment up to the date of his retirement. So you just have to apply, and there is no benchmarking, which will be done by the administrator at that time.
Yeah, okay. Right. Now, let's say an employer is contributing into a private pension scheme, and then the employee resigns. So as we discussed, the employer will still have to file an exit statement with the MRA. No.
Yeah. When it is under private pension scheme, it is, in a way we can call it, outside the scope of PRGF. It is between the employer and the employee, and the computation of the gratuity will have to be made by the employer, and from the gratuity that is payable, the employer will have to deduct from the screen that we saw, the computation that we saw earlier, deduct whatever need to be deducted, and then settle whatever need to be settled directly with the employee. But in case of a personal pension plan, I think they can, it's portable, they can just move the funds from the pension plan to the employee has got this choice.
Okay. Now, let's say an employee has resigned prior to January 2022, but within the 2-year suspension period. And the employer at that time has not yet started contributing into the PRGF. And the employee has resigned. Is there a deadline for the employer to submit the exit statement and settle past services?
In fact, during this period of transition, because just think about it, the PRGF has been suspended for 2 years, but these 2 years have been 2 very difficult years, we can say, for employers. So what has the Ministry of Labour has issued a communiqué and requested employers to settle their gratuity directly with the employees, without having to submit an exit statement, without having to carry out a benchmarking exercise. But if the employer and the employee are not able to settle the gratuity, then they will have to go to the Ministry of Labour, who will act like as if an intermediary trying to make things settle. But if even that, they can't settle the issue, then we have got some cases where then there is no settlement. The employer is required then to submit the exit statement. And based on the exit statement, a benchmarking exercise is carried out, and the employer is required to pay. In that case, there will certainly be shortfall, is required to pay the shortfall to the MRA, and this shortfall is credited to the employee's account, and the employee will get the benefits of this contribution when he will retire in accordance with the provisions of the Workers' Rights Act.
Okay. One question for Bernard. For a private pension plan, is there a benchmark for performance of the plan that is provided by service providers?
Do you mean investment benchmark, or what do you mean?
The benchmark that will be like in the PRGF, there's a benchmark that will be used now compared to a private pension scheme. Will there be some kind of similar benchmarks?
Yeah, it depends whether the private pension scheme is defined benefit or defined contribution. So if you take a defined benefit scheme, then the benefit will be determined by the formula based on years of service and the last salary. In a way there is, so let's say the person is entitled to a pension of 1,000 rupees, because not a long period of service, 1,000 rupees payable from the age of 60 or 65. The pension scheme will keep a record of that and pay that pension when the person claims the pension at the age of 60 or 65, whenever the retirement age is. So in a way, that's where there is a calculation like that. Otherwise, it will be the value of the contributions. So if you take a parallel with PRGF, so benchmarking only applies in a defined benefit scheme, because the benchmarking in PRGF is actually because it's a defined benefit there as well. Whereas if it's a defined contribution scheme, then it will be the value of the contributions made by the employee and employer with the investment return that has been accumulated. That will be payable not to the person in cash. Again, it's kept until it remains invested until it's paid at retirement age. If the employee wants to transfer that amount to a new employer scheme because they moved on, then they can do that, or even a personal pension plan, they can do that. Yeah.
There's a legal question for Zuleika. How can an employer hold the pension plan provider accountable for performance?
Sorry, can you repeat that?
How can an employer hold the pension plan provider accountable for performance?
Well, I mean, you mean in terms of a private pension scheme, I would suppose. In terms of a private pension scheme, well, there is the law, the Private Pension Scheme Act, which regulates the obligations of a private pension scheme towards the contributing employer, the sponsoring employer, as we call it. So there are, provisions about, the obligations, and in case of failure to fulfill these obligations, obviously there is a penalty under the law. But obviously, normally what happens in such a situation is that there is a contract between the employer and the insurance company that will provide that kind of service. So obviously there's going to be a contractual arrangement, and the employer can also go under the contract and make sure that the private pension scheme is accountable in terms of any obligation that it has. So there is the law, and there is also the contractual remedy on the side. Yes.
Okay, thanks, Zuleika. I think we've got only a few minutes left, so I'll just conclude. Firstly, I would like to thank all the speakers for having participated in this joint webinar organized by Andersen in Mauritius and Prism Chambers. Thank you. Andersen will be delivering an MQA approved training on the practical aspects of PRGF in the coming months. So definitely we'll be having more sessions together to clarify some of the practical aspects of PRGF. And in case you've got any questions with regards to PRGF, just feel free to contact myself or inbox to the Andersen mailbox or to the Prism mailbox. Thank you to all of you, and we hope to speak again later.